The US equity market has pretty much crushed the rest of the world for over a decade, and a large part of that success comes from those tech megacaps, which dominate all of our lives. But the question is now whether that trend will reverse, and in this video we'll talk about 5 reasons why that might be the case, and how these tech stocks could act as an anchor dragging down US equity returns. Now, if you do want to learn more about investing, you can do that as part of our Patreon community. To learn more about that, just click on the link beside me and in the description below me. So let's look at the US tech rally and whether it's about to end in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Now, you may be thinking, we've just had US earnings and they were very strong. What's the problem? And that's picked up in this story from NASDAQ, which is about the FANG stocks, which are the largest tech stocks, which says how they've crushed earnings, and it's another great reason to buy them. But of course, NASDAQ would say that because these stocks make up half of that NASDAQ index. But if we look at the earnings results, you can see that they're very positive. So you can see the actual earnings per share beneath me for those large tech stocks. And the usual practice is to compare it with estimates made by brokers before the numbers are published. Now, that's based on guidance provided by the individual companies to the analysts, and then companies surprisingly often beat those estimates. But for Q1 2021, the surprise was larger than usual. So there's no question this was a very strong earnings result. The only one of these which disappointed a bit was Netflix, which didn't manage to grow its subscriber base as much as expected. And historically, these companies have all been very good indeed at growing their profits. So here's the historic earnings growth, which is year-on-year growth, broken down by quarter going back to 2006. And although there were dry spells, so for example between 2012 and 2016, a lot of them struggled to grow profits, generally the earnings growth for these stocks has been incredibly strong, as has their ability to generate huge cash flows. And what many of them have chosen to do with that cash is to buy back their own shares. That pushes up the share price by concentrating ownership in the hands of existing shareholders. And that brings us to our first problem for US equity, which is concentration in these stocks. Here's a beautiful visualization of the S&P 500 showing its 1-year performance stock by stock. Now, the size of these squares is proportional to the market capitalization of each company, which is the dollar value of all of its shares. You just take the share price multiplied by the number of tradable shares. And it's clearly dominated by a few heavyweights such as Facebook, Apple, Amazon, and Microsoft. Now you can see the odd one out is Netflix, because that's quite a small company in terms of market size. But the other thing to notice here is that each of them dominates its own sector. So above me is communication services, and you can see that Google and Facebook completely dominate that sector, making up about half of it. Similarly, for consumer cyclicals, you can see that Amazon and Tesla dominate, and in technology, the heavyweights are Microsoft and Apple. So how unusual is it for just a handful of stocks to dominate an index like the S&P? Well, one way to look at that is as the ratio of the NASDAQ index, which is tech heavy, compared with the S&P 500. So I simply divide the NASDAQ by the S&P. And what you can see is that gradually over time since 2005, that's been increasing as the size of the NASDAQ grows. Now, of course, the S&P has grown as well, but the NASDAQ has grown more. There's a really good sector concentration tool that comes from MSCI, which allows you to visualize how the sector composition has changed over time and for multiple indices. So here what we're looking at is MSCI USA. You can select other indices as well, but if we choose information technology, which is this black bar here, you can see that gradually it's been increasing over time, as those tech stocks have started to dominate the US equity index. And if you move this slider over this 20-year period, you can see which stocks dominated each sector. And the latest numbers from March 2021 show that Apple and Microsoft are the really large components. And if we compare that, say, with MSCI Europe, you can see that it doesn't have such a large concentration in just one sector. Goldman Sachs has produced this graph which shows the concentration of market cap in the 5 largest stocks in the US. Now the average is 14% going back to 1980, and at the moment we're well above that, at about 1/5 concentrated in those 5 largest stocks. Now the grey shaded regions on this graph show you recessions, and what's slightly worrying is that these periods of concentration often come before a recession, and they also usually come before a very sharp market sell-off. So it looks as if sometimes, but not always, when we have a very large concentration in just a few stocks, the end game is usually a big sell-off. But of course this tells us nothing about timing or whether there's a causal relationship between the two. But the story in these previous episodes has been one where earnings eventually disappoint for the concentrated stocks, and then that drags down the whole index. The second factor which many people are worried about is tax. If we look at corporate tax rates by decade, so we've got 1980, 1990 and so on down to 2020, this shows the distribution of corporate tax rates in countries across the world. So in the 1980s, most countries had rates between 30% and about 50%. But notice how gradually over time the rates have moved down. This isn't altogether surprising because multinational companies have a lot of money, a lot of political clout, and they're very good at negotiating with governments to reduce their tax rates. And if we look at how that varies across countries with the same shading, so 1980s in dark blue up to 2020 in orange, in almost every region and country we've seen a similar trend, which is a downward move in corporate tax. So what's been shocking recently is that the G7 has reached a historic agreement on how they're going to tax multinationals, such as these tech companies. And this happened at the G7 meeting of rich countries in June 2021. The catalyst for it was that governments need money in order to rebuild their infrastructure after the pandemic. And where could that come from? Well, a popular one is corporate tax increases. And it certainly makes sense given the nature of business today, which is usually international. The old tax system was very much based on physical presence. So if you had an office, a central office in a country, that's where you'd primarily be taxed. Whereas the new rules aim to tax based on the location of a company's sales. And of course this plays very well to politicians because it's popular to get multinationals to pay tax so that your citizens don't have to pay so much tax. And this is the geographic breakdown of the last 12 months of turnover for Amazon. And while the US makes up the bulk of their turnover, almost 70%, you can see that other regions are also very important, such as Germany, the UK, and Japan. And while Amazon's business model is very much based on physical products, except for Amazon Web Services, which is growing very quickly, for many companies which are service-based on the internet, their business model has no physical boundaries at all. So what tax rates are they actually proposing? Well, as Janet Yellen says here, and she represented the US at the meeting, there's going to be a global minimum tax rate of at least 15%. That means that some countries may even choose to have it higher than 15%. And the reason for this is to avoid a race to the bottom, where one country just chooses to set its corporate tax rate very low to attract capital to itself. And if we look at a map of corporate tax rates across the world, you can see the ones where rates are very low in dark blue. And Ireland, for example, is one such country. So the new rules are an attempt to stop that by setting a minimum at 15%. However, for the FANGs, I don't think this is going to be a problem. And this is based on arguments from Justin Post, who's an analyst for Bank of America. As he points out, half of the revenue from the FANGs comes from outside the United States. And if we look at the breakdown of the tax rates, both within the US and outside, international tax rates for those companies are between 10% and 14%, and for the US, they pay about 21%. And when he combines that information, Justin Post finds that that'll be a small impact on profits. He thinks it'll only raise the average international tax by about 2%. And the impact on profit will be negligible, just minus 2.4%. So personally, I think the new tax regime isn't necessarily going to be a problem for these FANG stocks. I think a bigger problem is going to be legal. There's been a slew of stories recently about legal attacks by countries against big tech. This one was from April 2021, where the UK, Germany, and Australia were concerned about large mergers and acquisitions because this concentrated power in the hands of too few companies. So this was a story about stopping those mergers to stop these big companies getting even bigger. Another worry is about the amount of data which these companies hold about us, because they can literally track us minute by minute as we walk around. And then they can also use that information to target advertisements which are tailored to our interests and our circumstances. And that makes a lot of people very uneasy, particularly in Europe, but also in many other countries. And the argument is that it gives these companies an unfair advantage relative to other advertisers. And these antitrust cases are not just hot air. In fact, recently Google was fined 220 million euros for just such an antitrust case in Europe. Now, 220 million is just pocket change for Google, but what's more worrying from their point of view is that this case could provide a blueprint for other lawsuits against Google, from US states like Texas, but also by regulators in countries such as Brussels, the UK, and Italy. The fourth worry would be inflation. Now, the US central bank's view is that inflation is going to be temporarily high and then it'll gradually come back down to 2%. And that's because it's driven by temporary factors such as base effects, where we compare year-on-year prices, and at the moment we're comparing with the onset of the pandemic, and bottlenecks of supply will ultimately be resolved. But if you don't agree with that and you think inflation is going to be high for some time, then this graph might worry you. What I've done here is to break down returns by sector in the US, and I've looked at the difference between a high inflation regime and a low inflation regime. And what this shows is the difference between the two. So the bars in red are sectors which tend to have lower returns during periods of high inflation. And you'll notice many of those mega caps come into these two categories. So Amazon would fall into consumer discretionary, and Apple and Microsoft would fall into tech, both of which are negatively impacted by inflation. The last factor, and perhaps the most difficult one to judge, is whether future growth will resemble recent growth. What's pretty surprising is this breakdown of profit and turnover according to whether you're one of those big tech stocks or you're not. Notice how the share of revenue for these companies is very small, just 2% of the S&P 500, whereas they make up much more of the earnings or profits of the S&P 500. That's almost 15%. Why is that? Well, it turns out that these companies have extremely large margins. For every dollar of turnover which they have, a lot more of that turnover gets turned into pure profit. And if we exclude Amazon, you can see that the current level of profit margin for these companies is over 25%. And that's far higher than it is for the S&P 500, which is the blue line. For the rest of the S&P 500, you get about half of the margin. So one potential problem for these companies could be that their margins start to fall, particularly if those antitrust cases do push up their tax liabilities. Remember that 15% was just a lower limit, and some countries may choose to charge even higher rates, particularly Europe. And we'll finish with some interesting points from a UK asset manager, which is the UK version of ARK. In fact, it tracks ARK's returns very closely. That's the blue line here for this fund, which is called Scottish Mortgage. It's not a great name because it's a global fund for starters, and secondly, it's got nothing to do with mortgages. But hey, the name of my company is PensionCraft, so I can't really criticize. But what's remarkable about the portfolio changes that Scottish Mortgage has done recently is that it's moved away from US megacaps. So for Amazon and Tesla, it's halved its allocation, and for Facebook and Alphabet or Google, it's cut its allocation to zero. But they weren't very high in the first place. And the reasons given for that by one of the fund managers, Tom Slater, who's beside me here, are really interesting. Firstly, he acknowledges that these companies have been prodigious cash flow generators in the past. However, he says the question for him is how they're going to deploy their resources in the future to retain these growth dynamics at such a vast scale. What he's effectively saying is that he doesn't think they can scale their growth to be as high as it was in the past. And it's not totally surprising that he thinks that companies in China are able to scale better. And he gives three nice examples, which are part of his portfolio, of course. The first one is Tencent, which is a software services company, but in fact it's been using its cash to invest incredibly well. And it's managed to build up a portfolio of over $200 billion. Another example is Pinduoduo, I hope I pronounced that right, which has overtaken Alibaba's audience size in a very short space of time, about 6 years. And it now has over 750 million customers, and its business is selling agricultural products. And the last example is ByteDance, which has come to dominate advertising, digital advertising in China in the space of a decade. So those are my 5 reasons why I think the US tech rally might be about to go in reverse. I certainly don't agree with all of them, but I'd like to hear what you think based on your views about inflation and concentration in the comments below the video. It's always interesting to hear what other people have to say. Now, if you want to keep up to date with topics in economics and investment, you can sign up for our free weekly market roundup. I try to keep it topical and interesting, and there's usually a funny tweet at the end, which always seems to get the most clicks. But if you want to do that, there should be a link next to me and in the description. And as always, thank you for listening.